Let's get across the market open now. Kyle Rodder joining us from capital.com. Kyle, welcome back. Good to see you. Let's first start in the States. Look, we did see tech stocks move higher. All about those deals that Donald Trump is doing in the Middle East at the moment.
Yeah, that's certainly helping boost sentiment. Obviously we've got more or less the president acting as sort of a salesman for the United States and sort of hopscotching across the Middle East to, basically secure deals primarily for Nvidia and obviously other sort of crucial parts to sort of chips and semiconductor industry. And then also kind of touting a bit of a we're open for business narrative, which is, far more constructive than the, tariff protectionist rhetoric that had prevailed for 6 or 7 weeks. So, really we've got markets kind of normalizing as far as trading conditions now. Volatility is coming back to ranges typical of a fairly calm and bullish market. There wasn't a great deal of follow through with the early week rally that we saw at the start of the week last night. Maybe we're waiting for a little bit of the data to drop in the next sort of 24 hours or so. But overall, it has to be said, markets are behaving rightly or wrongly as if the tariff scare is something of a feature of the past, and maybe won't result in anything more than a sort of short and shallow slowdown. And instead, they're looking to the future of potential tax cuts, potential interest rate cuts, and of course a president that seems to be far more interested in doing deals with people rather than punishing them with high tariffs.
Interesting though, because obviously those equity markets have run hard since we've had that news out of Switzerland on the weekend. Some strategists looking perhaps that's saying they're overbought now.
Perhaps slightly in the short term. I mean, there's nothing that really screams to me that they're overbought in any kind of meaningful sense. I mean, if you compare it to positioning and the technicals at the start of the year, say February or so, where everything was, very, very bullish, but very richly valued and very overstretched. We're not really there yet. In fact, I'd argue that there are still sort of bears sitting on the sidelines, waiting for the pullback to come through on the basis that, we're still to see in the data the material impacts of the uncertainty over the last 6 weeks or so, or whether that be on earnings guidance or the earnings outlook, or whether that be in the macroeconomic data that we get. Whether it be, for example, jobless claims tonight, which haven't really shown any signs of layoffs or anything of that nature. So, maybe there's a little bit of a pullback there if you look on a really short time scale. But if you look at, again, sort of market positioning, if you look at just the pure technicals in the market right now, valuations are kind of rich, but certainly not as rich as they got to at the start of the year. There's nothing that screams to me that this is an eye-wateringly overbought market, at least in the bigger picture.
What are we seeing, particularly with the US dollar at the moment, perhaps reflecting that American exceptionalism is back?
Well, sell America's done for now anyway. I mean, as long as Trump maintains this kind of deal-first attitude when it comes to trade, the pause has turned into, prolonged deals, I guess you could say, or at least we don't sort of see a lapse in these pauses on China's tariffs and other trading partners in the next sort of 60 to 90 days, depending on which one you sort of look at. As long as that sort of continues to be a feature of the past, then the dollar can kind of recover. We sort of see the unwind of that sell America trade. It's why we've seen US equities outperform this week. Partly it's because clearly tariffs were going to be detrimental to the US economy more than anybody else. So we're sort of pricing in a better growth outlook. But the other element is that, the trade policy was really causing a crisis of confidence in America, and there was this sort of sell America trade sort of prevailing that's now being reversed quite rapidly. So that's all to say that when you do look at something like the US dollar, as we've got the same kind of dynamic driving the currency now. The Fed is looking as though, or markets pricing in fewer rate cuts from the Fed because the economic outlook is assumed to be better because there will be fewer lower tariffs. Much lower tariffs than there would otherwise be, and there's a level of restored confidence in US assets that the Trump administration isn't going to blow up the global trading order, isn't going to put too much strain on the financial system. In the long run, there's still going to be a credibility crisis that will be discounted into US assets and the US dollar. We're already sort of seeing signs that major trading partners are looking to other places to park reserves than US Treasuries. I mean, China was already doing that for years, but there is that sense that there will be some permanent scarring there. But in the short term, as the market's priced out the worst case scenario, the US dollar is sort of benefiting from, again, that sort of cyclical element of not as bad as expected slowdown, as well as that kind of slight restoration of credibility in US assets overall.
Kyle, locally we do have jobs data today, perhaps further informing the RBA ahead of its meeting next week.
Yeah, could do. And, we did see after the wage price index data that, at the margins, markets priced out the odds of a rate cut. We did see a bit of a lift in yields, especially at the front end. It was pretty trivial in the grand scheme of things going into this stage today. We do have the markets pricing, call it a 99% chance that the RBA will cut next week, and part of that too is just the kind of change that we've seen, or the move that we've seen in rates markets in the States, having an impact on local rates pricing as well, which is just to say lower tariffs, marginally stronger growth than what would otherwise be, therefore less need for deeper rate cuts going forward. But if we do look at the bigger picture and certainly put this into sort of longer term trends, despite the fact that the Australian economy has been quite anemic for quite some time now, and we've seen that showing up in GDP data, we've seen that showing up in measures of consumer activity, the jobs market has been fairly resilient, and probably the one thing that many people have pointed to as an indicator that really we don't need rate cuts just yet, because the RBA is doing its job in terms of its employment side of the mandate. But we're expecting that the economy added about 20,000 jobs last month. The unemployment rate remains in the low fours, somewhere around 4.1%, pretty much steady for all intents and purposes. And given the rates market pricing, one expects that if it comes pretty close to the pin, then the markets will look forward to next week with the expectation, a very, very high expectation, that the RBA will cut interest rates. Given the fact that the RBA hasn't come out at all to push back on that pricing, and that we do have that inflation data a few weeks ago showing that, okay, maybe inflation is not moving on the sort of trajectory that we'd hoped. It's not trending as in a fashion that is perhaps going to get us to the 2 to 3% midpoint as quickly as previously thought. It's still within that target band, so all the ducks are lined up for a rate cut. So again, it will take a very strong data release today to shake those expectations, I think, of a rate cut. So if we get pretty close to the pin, I think the markets will be looking for that 25 basis point move next week.